Hi, Julie Farrell with Directors Mortgage. Thanks so much for joining me on Julie Does Loans. Today I've got Tammy Golden with Arch MI. She's an account manager, and not only that, she's a friend. You have been a resource for all things mortgage insurance for me for a very long time.
Yes.
We're not going to go into details for how long.
Thank you.
But your credibility is certainly noteworthy. And there's a few myths that I just wanted to talk about right out of the gate.
Sure.
Because I think mortgage insurance comes along with a bit of a bad reputation that you want to avoid mortgage insurance if possible. Well, of course, that would be nice if we all had 20% down payment to purchase a home with. But if you don't, there's some real advantages to mortgage insurance, such as increased buying power.
Correct.
So let's talk about that first.
Yeah. So if you think about, like you said, the myth out there of having 20% down, say maybe you only had $20,000 as a down payment. $20,000 and you thought you were going to put 20% down only buys you a $100,000 home.
Right.
But 10% down, now you've got a $200,000 home. Or even with just 5% down, now you have a $400,000 home. So it truly increases the buy power for your clients. Additionally, most often you have a better rate with mortgage insurance than you do without.
Yes.
And
because the risk is offset.
Correct.
There's mortgage insurance to protect the investor that's carrying the loan.
In the event that the borrower defaults on the loan. Correct.
Exactly right.
Yes.
So you can take that instead of a 20% down purchasing a $100,000 home and parlay it into a $400,000 purchase. Yeah. I want to hit on the advantages of private mortgage insurance over government mortgage insurance because there's a lot of different points, but we brought up just a few great ones that I want to hit on.
Correct.
So first and foremost, lots of flexibility with private mortgage insurance, whereas very little to none on
FHA. Well, FHA definitely has its place in your book of business. I think that private mortgage insurance allows you different payment options. So you can do a monthly, you can do a single, you can do lender paid, and you can help your clients with that. Whereas FHA requires a set amount up front and then monthly mortgage insurance at a set price. And you're stuck to that. And then if you put less than 10% down on an FHA loan, you can't cancel that mortgage insurance. Whereas with private mortgage insurance, you can cancel that MI at a certain point in time.
Which is fantastic.
Right.
Especially in the gains in equity that we're seeing year over year in our area.
Absolutely.
That can be a really nice option to know that specific monthly mortgage insurance payment is removable once you can prove that you have at least 20% or more equity in the home. Yes.
And
you can also use it to purchase a second home, you were just saying. That's fantastic.
Yeah,
so less than 20% down.
With FHA.
Right, on a second home. Fantastic.
Yes.
Love it. Well, that's really great information. Yeah. Thanks, Tammy.
Yep.
So we touched on the option to remove mortgage insurance. When does that become available? Let's talk about those rules, because removal of mortgage insurance, I don't think very many people understand that that's an option with private mortgage insurance, not with USDA or FHA less than 10% down.
Yeah. Biggest question I get asked right now, aside from how to get mortgage insurance, is how to remove mortgage insurance, which is no surprise with the gains in equity that everyone has seen in today's marketplace. And so the mortgage insurance will automatically be removed at 78% of the... Automatically under the Homeowners Protection Act.
That's amazing.
Or the borrower can petition with their servicer to remove it at 80% of the loan to value. So as long as your payments are all made and you are current on your mortgage, you can advocate to remove that mortgage insurance on your own.
Absolutely. And I have made that call with several clients to their servicer to... Some of them have an application. Some of them want to see an appraisal or some sort of professional opinion on value. Others have application fees, but some don't. Some are just like, we're going to pull an automated valuation and you're there. We're good.
And some changes were made within the last couple of years to make it a lot easier for the average consumer to make that phone call and have that removed.
Oh, that's great to hear.
I think there's been a misnomer that it's climbing mountains or big hurdles in order to get that mortgage insurance removed, and that's simply not the case anymore. So
that's really good to hear. Yeah. Thanks for sharing.
Of course.
Yeah. Well, what's one thing about mortgage insurance that would surprise people, that you surprise people with?
I think the payment options and just making sure that you as an advisor really can have a more consultative approach with your clients and finding the right mortgage insurance option for your clients to meet their needs. So whether this is going to be a forever home or this is a short-term investment or however they want to play that out. Maybe they've got a large amount of money up front, or maybe they don't have any at all, and making sure that you meet all of their financial needs by using mortgage insurance to acquire the home of their dreams.
Well, and I have to toot your horn because you were the first mortgage insurance advisor to teach me that there are elements that can go into the scoring model, making pricing better for certain situations, certain recipes, if you will.
Right. So different if you've got loan attributes can create a different rate. So
yes. And I love that about Arch, and it allows me to tailor it more to the client's needs. Tammy, tell me the basics of mortgage insurance.
Sure. Just a little refresher. So mortgage insurance allows borrowers to purchase a home who have less than 20% down. So if you put 20% or less down on your loan has to carry mortgage insurance unless you go with a different government program. And as a reminder, mortgage insurance protects the investor or the servicer in the event that the borrower defaults on the loan. So I think there's a lot of misnomers about what it is. No, we're not paying off your mortgage once you die. That's a different type of insurance. This is truly just insurance on your loan. And it protects the investor, so it allows you to have more of a buy power. So
put less money down.
Putting less money down.
It also is typically tax deductible.
Yes.
And it can often, not always, but often help improve pricing on that interest rate that you're obtaining with less than 20% down.
Absolutely.
Because you've got that additional insurance policy reducing the risk.
That's considered a credit enhancement. Absolutely. And then once you obtain the mortgage insurance, a lot of different payments, a lot of different factors go into creating your rate. So if you kind of think about it as car or auto insurance, you've got your 17-year-old kid driving a red sports car versus your grandma in a grocery getter, those rates are going to be different. Much like the insurance world, mortgage insurance acts the same way. And so those loans that have more risk attributes, higher risk attributes, can sometimes be more expensive than those that have lower risk attributes. And that's something you can help consult your clients on.
Absolutely.
Yeah.
Absolutely. Thank you so much for joining me and for doing this. I know that not everybody is keen on getting in front of a camera. I'm not all that keen on it either, but I love what we're doing. I love the education component of it.
Me too.
And
it's a privilege to be here. So thank you for the invitation.
Thank you.
Hi, Julie here again. As we were watching back through the video, we noticed that we may have caused some confusion. So I'm going to take just a minute to explain dropping mortgage insurance just a little more in depth. So partway through, we said that a servicer is required to drop mortgage insurance automatically at 78% of your loan to value. How that would be determined is 78% of your loan to value based on the value assigned through the original transaction. Your servicer isn't checking Zillow on a regular basis to see what your home is worth. Also, each servicer has the ability to create additional rules or requirements about dropping mortgage insurance. Some may allow you to apply for removal anytime during your mortgage, while others may have a period of time that you have to wait. Others may even require receipts showing improvements made to increase your home value. Ultimately, servicers may not drop MI just because home values have gone up and you're under the 78% loan to value threshold, because they can't add it back if that value changes again. So instead, they may require a waiting period in order to ensure a new appraisal provides stable and realistic valuation. If you have questions, please reach out, as every servicer is a little bit different. I'm more than happy to help you navigate what your servicer might require for you to get that mortgage insurance removed.